A single sentence just incinerated $47 billion, and the operative who exposed it has already vanished from every government database. I need you to halt everything in your life immediately, because what unfolds in this video will permanently transform how you perceive your bank balance, your retirement savings, and every piece of currency you assume you actually own. Today marks Tuesday, January 20th, 26, the presidential inauguration, at exactly 11:47 in the morning Eastern Time, while planetary attention fixated on ceremonial proceedings at the Capitol. A restricted file materialized on a Treasury Department server for precisely 93 seconds before complete erasure. 93 seconds was sufficient for absolute devastation. Within 40 minutes, silver futures struck maximum allowable limits, and trading froze completely. Within 4 hours, one of Earth's largest banking institutions publicly confessed that delivering physical silver to customers who already completed payment was entirely impossible. At this precise moment, as these sentences reach your consciousness, two completely separate silver valuations coexist simultaneously on this planet. One of them is manufactured deception. The posted exchange quotation displays 127. That figure represents pure fabrication. Because in Dubai at this exact hour, physical silver bars exchange ownership at 486 per ounce. Tokyo concluded near 312. Shanghai finished around 287. The synthetic market and physical reality just permanently separated. And only one is communicating genuine truth to you right now. But here's the element that should authentically frighten you. I mean, generate genuine visceral fear. The banking institutions controlling silver markets currently owe 215 million ounces. They do not possess it. Total registered inventory sitting in exchange vaults equals 31 million ounces. They've commercialized 7 times more metal than physically exists anywhere on Earth. And today, somebody finally demanded they produce it. Let me reconstruct exactly how this systematic implosion unfolded minute by minute, because what transpired today will occupy financial textbooks for the next century. The catalyst was Presidential Directive 78. Section 3, paragraph 2 contains the 12 specific words that detonated the explosion. Quote, "The United States Treasury shall purchase physical silver at current market valuations." End quote. Examine those words again carefully. Current market valuations? No maximum threshold, no spending ceiling, no restriction whatsoever. The American government just announced unlimited acquisition of physical silver at whatever sellers demand. They avoided specifying caps at $50. They avoided limits at $100. They committed to current market valuations, meaning Treasury pays whatever becomes necessary to accomplish this. Now, why does that matter so profoundly? Please concentrate entirely here, because this is where most observers become completely confused. For multiple decades, 4 dominant banking institutions operated the greatest precious metals manipulation in modern financial history. They manufactured synthetic silver continuously, enormous quantities. They created paper certificates exceeding all physical silver existing on planet Earth combined. They extracted fees and premiums from customers who believed they purchased tangible metal. The entire mechanism functioned because nobody actually demanded delivery. Everyone simply exchanged certificates back and forth like casino chips. The melody played continuously, banks accumulated enormous wealth, and genuine silver valuations remained artificially crushed for 40 years. Today, the melody ceased abruptly. When Treasury declared unlimited physical acquisition, they communicated to every bearish position holder on Earth: produce actual metal or face complete extinction. The trapped institutions, veterans call them liability carriers, suddenly recognized they held 215 million ounces of commitments they could never possibly fulfill. Let me guide you through precise chronological sequence, because understanding exact timing is absolutely critical. 11:47 morning, the file surfaces. Someone inside Treasury, or someone with unauthorized access, uploaded the executive directive to a staging server. A financial monitoring aggregator captured it immediately. Within 90 seconds, every major trading operation in New York, London, and Tokyo possessed duplicate copies. 11:49 morning, the initial buying wave slammed into silver futures contracts. March 26, contracts jumped from 89 to 94 in under 60 seconds. Automatic circuit protection engaged. Trading suspended immediately. 11:53, trading resumed briefly. 11:57 morning, silver reached 114. Second circuit trigger activated. Exchange operators panicked completely and announced emergency margin requirements, 300% increase effective immediately. Now here's precisely where everything went catastrophically wrong for banking institutions, and perfectly right for everyone who comprehended what was actually happening. That margin adjustment was designed to frighten participants out of positions. Instead, it compelled dozens of hedge funds to liquidate holdings they could no longer financially maintain. The vast majority were bearish positions. When bears liquidate, they must purchase to close. Additional buying pressure generates additional price acceleration. Exchange administrators accidentally poured accelerant on their own fire. 12:15 afternoon, trading suspended indefinitely. Exchange operators issued statements regarding restoring orderly market conditions. Translation, they've completely lost control and possess zero strategy for recovery. 1:30 afternoon, London attempted price establishment, the benchmark fixed at 142, 53% above final exchange prints. But this is crucial. Zero physical metal actually changed hands at that valuation. It represented synthetic pricing for metal nobody would surrender at any number. 2 o'clock afternoon, the incoming administration confirmed directive authenticity. The president-elect, speaking from a capital holding area, announced signing would occur within hours. 2:40 afternoon, first blood drawn. A major Canadian banking institution announced immediate suspension of all precious metals trading activity. They cited unprecedented market conditions, but trading desk sources revealed different information. That bank just hemorrhaged $4.2 billion in a single afternoon. Careers terminated, fortunes vaporized, and the day was far from concluded. 3:30 afternoon, Asian markets initiated pre-opening sessions. Shanghai indicated silver at 240, Tokyo even higher. The divergence between synthetic and physical accelerated dramatically. 4:15 Eastern Time, the fatal strike landed. A European banking giant, among the most prominent and established institutions globally, announced force majeure on all physical silver delivery obligations. Let me translate that into language anyone can understand clearly. This bank informed customers who purchased silver and completed payment that this bank cannot deliver it, not choosing against delivery, physically incapable. The metal does not exist. They offered cash settlement at final official exchange pricing of 127. Consider what that truly represents for a moment. If you purchased silver through this institution expecting metal delivery, you're being offered worthless paper currency at a fictional valuation, while genuine silver trades at 4 times that amount in physical markets elsewhere. The entire foundational premise of synthetic silver died at exactly 4:15 this afternoon. Markets comprehended the implications immediately. Within 1 hour of that announcement, physical silver premiums in Dubai reached 300% above quoted prices. Singapore, 275%. In Mumbai, dealers simply disconnected telephones. If you attempted physical silver acquisition in India this afternoon, you could not locate a single dealer willing to sell at any valuation. Now let me reveal what is currently occurring behind secured doors, because this information originates from sources endangering their careers by sharing it. Emergency conferences are underway in Basel, Switzerland. The central bank coordination body has convened an unscheduled session of the Global Financial Stability Committee. The agenda is not silver specifically. The agenda is preventing silver's collapse from triggering cascading global banking crisis. Here is their fundamental problem, and it remains mathematically unsolvable. This is not liquidity deficiency. Central banks cannot remedy this by creating currency or extending emergency lending facilities. This is fundamental solvency crisis. These institutions made commitments they cannot honor. They commercialized metal they never possessed. The obligation is due and payment is impossible. The 4 primary liability carriers face combined exposure between 47 and 53 billion. Their total precious metals trading capital approximates 12 billion. They're submerged by factors of 4 to 6. 2 major European institutions are already engaged in active discussions with home country regulators regarding emergency rescue provisions. But here's the twist that transforms the entire situation. One American institution anticipated this outcome. They've been quietly relocating physical metal from exchange vaults since mid-December. The registered inventory figures appearing on official reports are increasingly fictional. Metal has migrated to private storage facilities beyond the regulated system entirely. This institution positioned advantageously months prior while publicly projecting opposite exposure. They will harvest billions while competitors collapse around them. This wasn't coincidental. This was orchestrated elimination. The institutions remaining trapped are predominantly foreign entities: the European giant, German banks, Canadian institutions, Swiss banks. They maintained bearish positioning even as warning indicators multiplied. They believed the game would continue indefinitely. They miscalculated catastrophically. Now let me demonstrate why $500 silver isn't speculation. It is pure arithmetic. Annual global mine production, 820 million ounces. Industrial consumption including photovoltaic panels, electric vehicle components, medical devices, and electronics, 680 million ounces. Investment demand adds another 250 million. Total aggregate demand, 930 million ounces. Total aggregate supply, 820 million ounces. Markets have operated in structural deficit for 6 consecutive years. And now the American Treasury enters as buyer with unlimited financial resources and a mandate to accumulate 50 years' worth of strategic reserves. That represents approximately 22 billion ounces against annual production of 820 million. No valuation exists where this equation balances without massive liquidation from current holders. Industrial consumers cannot substitute. Nothing matches silver's conductivity for photovoltaic cells. Nothing replaces silver in EV electrical architectures. Nothing provides equivalent antimicrobial properties for medical applications. Valuation must escalate until investment holders surrender everything, until the discomfort of holding exceeds the discomfort of selling. Our analytical frameworks place equilibrium between 450 and 650 per ounce. Not as temporary spike, as permanent new baseline. The exchange is finished as a price discovery mechanism. When major institutions declare force majeure, synthetic credibility expires permanently. Industrial consumers will abandon exchanges and negotiate directly with mining operations. Price discovery migrates to physical markets. No margin requirements, no synthetic shorts, no automatic trading halts. Here's what unfolds within the next 48 hours. Additional force majeure declarations. The European Bank won't remain isolated. At minimum, one additional major institution fails before Asian markets open tomorrow. Emergency regulatory intervention. Authorities will announce position restrictions and trading limitations. These will fail completely because the crisis is physical scarcity, not excessive speculation. Industrial emergency acquisition. Major technology manufacturers and every significant silver consumer will compete aggressively for physical metal at any price. They require silver for production. They will pay whatever becomes necessary. Retail surge activity. Silver dominates global headlines. Mass market purchasing commences. By the time typical investors comprehend what occurred, valuations will be entirely unreachable. Within 30 days, silver discovers temporary equilibrium between 350 and 450. Within 90 days, it approaches 500. Within 12 months, it establishes permanent range between 400 and 700. Previous valuations are extinct permanently. Now here's what this means for you specifically. If you hold physical silver, do not liquidate. Not at 200, not at 300, not at 400. You possess one of existence's most undervalued, strategically essential assets. Near-term volatility will be extreme. Disregard it entirely. Fundamentals have never aligned more favorably. If you hold synthetic silver through ETFs or futures contracts, you face significant counterparty exposure. Major funds hold inventory in identical vaults, now declaring delivery impossibility. The redemption mechanism was always illusory. Evaluate your exposure carefully. If you possess zero silver, today is not appropriate for panic purchasing at extreme premiums. Wait for volatility to subside. Monitor premium stabilization, then acquire what you can afford to hold permanently. Here's the profound reality underlying everything I've communicated. For 50 years following the gold window closure, global monetary architecture rested entirely on collective belief. Belief that governments manage currencies responsibly. Belief that institutional promises receive honor. Belief that systems function properly. Today, belief expired. When a globally significant bank admits physical commodity delivery is impossible for merchandise customers already purchased, something foundational fractures. Confidence once destroyed cannot regenerate. Silver represents modest total market capitalization. Even at 500, aggregate valuation remains under 2 trillion. Individual technology companies exceed total above-ground silver value. But silver matters enormously as proof of concept. It demonstrates synthetic claims can exceed physical availability. It demonstrates major institutions make commitments beyond fulfillment capability. It demonstrates systems we're assured are stable are actually fragile beyond comprehension. If this occurs in silver, it can occur in gold, in copper, in oil, in any commodity where synthetic trading volume exceeds physical inventory. And ultimately, it occurs in currency itself. What you're witnessing today isn't conclusion, it's commencement. The beginning of comprehensive monetary restructuring that will require years to fully manifest. Silver defies printing, silver defies counterfeiting, silver cannot be conjured from nothing by central banking authorities. That's precisely why they suppressed it for decades. That's precisely why, when suppression failed, reset was immediate and violent. This is Max Vault. Today is Tuesday, January 20th, 26, Inauguration Day, the day synthetic silver expired. If this helped you understand what's happening, hit that like button for Max Vault and share immediately with someone who needs awareness before tomorrow morning. Subscribe now because the next 48 hours represent the most consequential period in financial market history and will document every development in real time. In an era of unlimited digital abstractions, physical metal represents the only remaining truth.